to think here. We just have kind of a few months when we lower the stakes on the economic numbers because everyone is going to just kind of be idling for a while, or it could mean, that something needs to be done and nobody does it.
Well, we haven't heard about CapEx cuts yet. In fact,
cuts, yeah.
Right? I mean, maybe they just stay the same, and that's okay. And I just think headed into this year, it was always going to be a harder year, Mike, because we were growing 3.5% over the last 2 years. And that was because of the enormous fiscal stimulus that we put in place. Fast forward to this year, not going to have fiscal. We're going to have tax cuts and deregulation. That's going to be positive. We have to get through the tariff issue, and we're slowly getting through it. But if we wait for certainty, you're not making money when everyone feels good. When we're not worrying, we should worry because that means we're complacent, right? So to me, I think the Fed is behind the curve. I think they absolutely can cut. I don't think it's more than 50 basis points, but they should. I don't think tariffs, I think I can make a really compelling argument that tariffs are not as inflationary as most people think. Think about the productivity side of the equation. So to me, I was at 9% cash in February. I'm now at 1% cash today. Could we be a little volatile here? Sell in May, go away kind of thing? Maybe, but I think that there's a lot of opportunities.
Well, we do want to get a little further into what J.P. Morgan CEO Jamie Dimon said earlier today at the company's Investor Day. Leslie Picker has been there and is here with those highlights. Hey, Leslie.
Hey, Mike. Yeah, Dimon fielding a lot of questions, as you can imagine, about the topics you were just discussing. The macro picture. He characterized the current geopolitical risk as being, quote, very, very, very high. Dimon said people feel good because they haven't seen the effects of tariffs, calling the market's round trip essentially a, quote, extraordinary amount of complacency. He said even with today's current rates, the tariffs are still at, quote, extreme levels. And given all the macro uncertainty, he's looking at all sorts of scenarios and what they mean for the firm and the broader economy.
We do look at the range of potential outcomes. I think the worst one for a bank and for most companies is stagflation, which is basically a recession with inflation. I think the odds of that are probably 2 times the market thinks. I don't know what's going to happen. We will be fine. Okay, what happens in that is credit losses go up. They will not be like the global financial crisis. I think credit losses in a recession will be worse than other people think.
On succession, Dimon said the board has, quote, intent to think about succession. He said it's up to his directors as to whether he's CEO for 4 more years and maybe 2 or 3 as executive chairman, noting that's a, quote, long time. Mike.
It's a long time for some, considering how long he's been in the job. Maybe it's not that long, but very interesting stuff, Leslie. Thank you very much for that. So, I guess, Michael, we can say for sure we know that Jamie Dimon is he's the paid to worry type, right? He's kind of your wartime consigliere. He's looking at the dangers, not at the happy upside. That being said, do you feel as if right now we get back above 21 times earnings, credit spreads are tight, that the markets are overlooking the potential for some disruptions?
I definitely think they're overlooking it, and everybody knows that you have to be in the markets for the long term in order to capture that upside pop. There's going to be some positive news that comes out. There's going to be something that no one expects that's going to drive the markets higher. And again, we spoke about diversification earlier. It's important to continue to stay diversified, but stay in the game, stay in the markets, because anytime you, like when it 6 weeks ago or whenever that big pop was like 10, 11, 12%, you miss those days, you miss a lot of upside in the equity markets. I'm not as concerned as he is, and obviously he's much smarter than me and in a different position than I am, but I just don't see the concern right now, and I don't see any reason to panic, and I think earnings are quality. They are going to grow for the next 18 months.
Yeah, I mean, look, Dan, the other piece of it is, of course, he's Dimon talking to investors in J.P. Morgan, trying to convey that J.P. Morgan is going to be, the last castle that's standing if things go really bad. On the other hand, I do think there's a way to kind of get a reality check and say, look, we're pretty much nobody's expecting 30% China tariffs. We celebrated 30% because it came down from 145 or whatever. But where does it have to go for us to feel as if there aren't going to be significant disruptions? Or can we just have comfort in the fact that, in general, the U.S. is kind of not a trade-dependent economy? Goods imports from China is 1% of GDP, and basically say it's just going to be lost in the sauce?
I don't want to say it doesn't matter, because it does, but I think your latter point is probably more valid than people give it credit for. But I do want to answer a question you didn't ask, which is just to say, listen, to Michael's point, Jamie is obviously the most accomplished bank CEO on the street, deserves to be CEO until he doesn't want to be anymore, presided over the expansion of the best banking franchise in modern banking history, I would argue. But that said, there's a camp of very smart, very accomplished, very rich people who have been very bearish for a long period of time. Not just the last 2 or 3 years, but the last, call it 8 or 10 years. To varying degrees. The market has been expensive. This is all because of the Federal Reserve, et cetera, et cetera. And one of these days, something is going to happen poorly. There's going to be a recession. Earnings are going to get cut in half. It's going to be a big deal. And a lot of people in that camp are going to say something to the effect of, I told you so. But for viewers of this show, that has done you almost no good for the last couple of years. And to Michael's point, if you were out of the market when the S&P was up 9% in a single day, when the S&P, when President Trump sort of abandoned the worst tariffs, you miss a big chunk of the gains. And so, again, there's a lot to worry about, but there's always a lot to worry about. There's going to be volatility, but there's always volatility. And I just think people, and again, Jamie Dimon, better, more accomplished than me, not quite as good looking, but I'll go with what I got. I just think this idea that there's always something to worry about, it's just for a lot of viewers of the show, it's just not worth it.
Well, that's true. And so maybe the I told you so's are going to be beside the point. But if things go really badly, so will the idea that the bulls had it right for 10 years be worthless, right? I mean, at the lows, we clicked for a moment in April to a level where we finished 2021.
Sure,
okay.
But I'll take 10 years of gains if I have to give back 1 year. I'll take that all day long.
That's 3.5 years.
10 years
That's
up,
3+
1 year down.
years. I know what you're saying.
The average for the S&P 500 over the long term total return is 7.7%.
No, exactly.
So 20% in the last 2 years is not normal, right?
That's right.
So we just got to keep it all into perspective.
Right, exactly. So in other words, over time, there could be some payback and all the
Of
rest.
course. Mean reversion, of course.
I do think you're going to start to see M&A pick up, and that's going to drive markets higher. That's going to drive a lot of activity.
It's going to drive Jamie Dimon's
That's a point I wanted to get to as well, because it seems as if the market is maneuvering somewhat in that direction. Even last week, first of all, the brokerage index hit a new high. Overall, S&P has not get back to a new high. You saw IPOs, recent IPOs start to fly. All the fintech companies that couldn't get out before, they're filing again. So people want to kind of rewind and say, oh, we got the animal spirits trade back. However, at the same JP Morgan investment meeting, the CFO was like, actually, capital markets looking like it's a little bit rough for the current quarter, right? So I guess the question is, maybe you believe it when you see it in terms of M&A?
Yeah, I think
IPOs?
And well, it just has to pick up. There's too much money on the sidelines. There's been too much money on the sidelines for so long, and the rates are not moving in a direction where it's worth it to hold the cash. And even though we've gotten higher rates than we've had in the last 10 years, I just believe that there's so many people out there looking for so many deals on both sides of it. And you're even seeing value in technology companies where they've shot up so much, and now they've taken a step back. You're seeing these values like in those IPOs, like you were mentioning.
Dan, what is the credit market telling you at this point, aside from the fact that not very worried, actually? And, you would think you have the makings of, some kind of capital markets driven transaction type phase here, given where spreads are. But maybe the absolute yield levels are not necessarily a no-brainer for LBOs and things.
Yeah, there's a lot of truth in that. But to answer the initial question, the credit market is doing much of what the equity market is doing. Spreads are very tight, but at least in high yield, it's a very high quality market relative to history. There's no signs of worry in any sectors. I mean, obviously, traditionally, you have one sector in credit that's a problem, whether it's energy or telecom or retail. You're not seeing a whole sector in trouble right now. Granted, energy was a whole sector that was in trouble, but there's very little trouble left there. So I don't think you're hearing very much. You're seeing some M&A activity. Charter just recently bought Cox, so there's some stuff going on here, or is it attempting to? There's the AT&T fiber deal was just approved to close. So you're seeing some activity here. The SPAC market has opened up. There is signs that things are game on. And to your point about we'll see it, we'll believe it when we see it, that might be a problem for markets in 2 months or something when some of the tariffs start coming into place. Maybe it's more onerous than perhaps the three of us think. But right now, things look okay.
And Steph, it still remains a little bit of a large cap quality focus to a degree. I mean, you have the Russell down 0.7% today. Obviously, rates don't help on that front. So is that where your kind of stock by stock work is taking you, into more quality? Because you also have seen cyclicals do well.
So I think it's cyclicals. I think it's also some of the Mag 7 that got hurt. Still, a lot of them are not back to where they were, right? So I think there's an opportunity there as well. All of last year, unfortunately, I wasn't in the Mag 7, all but one or two, and I've actually been taking advantage of that because you can't ignore the strong free cash flows and the moats, and now all of a sudden a little bit more negativity in them. So I think there's opportunity there, but I'm still a big, big believer in data centers and the infrastructure industrial companies that are going to benefit from that. Financials I like a lot as well, especially if NII improves. Mike, no one's talking about that, and that will help a lot in terms of earnings for the banks.
Yeah. Well, the quality indexes are full of Mag 7 and industrial,
Yes.
so that's kind of where it takes you. Steph, Michael, and Dan, thank you so much. Appreciate that.
Thank you.
All right, let's send it over to Christina Partsenevelos for a look at the biggest names moving into the close. Hi, Christina.
Hi, Mike. Well, let's start with United Healthcare rebounding today, up about 7% after the stock hit lows last week, shedding roughly 23% after suspending its full-year guidance, former CEO Andrew Whitty stepping down, and reports of a DOJ investigation into its Medicare Advantage business. The stock still down nearly 40% for the year. And Reddit falling after a downgrade to equal weight from overweight at Wells Fargo, expecting, quote, user disruptions to become more permanent, particularly among logged out users as Google fully integrates artificial intelligence into its search, decreasing its price target, this according to the analyst, to 115 from 168. You see the shares down almost 5% right now, Mike.
All right, Christina, thank you. Talk to you again in a bit. We are just getting started here. Up next, investors gearing up for a big week of retail results. Top analyst Oliver Chen standing by with what he'll be watching when Home Depot, Target, and TJX all report. He joins us after this break. We are live from the New York Stock Exchange. You're watching Closing Bell on CNBC. See the Dow up 70.
for certain.
President Trump targeting Walmart over the weekend, posting on social media that the retailer should stop blaming tariffs as the reason for raising prices, adding that the company should, quote, eat the tariffs. The retailer said last week that it may need to hike prices to offset higher import costs. Walmart, not the only retailer feeling the pressure as we gear up for a busy week of retail earnings. Target, Home Depot, TJX, and Deckers among the names that are set to report. Joining me here at Post 9 with his outlook on the group, Cowen's top retail analyst, Oliver Chen. Good to see you, Oliver.
It's a
Thanks
pleasure
for coming
to be here,
in. I mean, just to start off with Walmart, which is a stock that you do like, how do you filter in the tariff concerns to the thesis, the earnings model, and how you think it'll play out?
Yeah, in terms of their earnings model, it could hurt earnings per share by 5% or more. But Walmart has been a top idea for us because it addresses needs plus wants. It has a great value leading grocery business. In addition, technology. Think about digital marketing, digital advertising, and the marketplace. In addition, Walmart, ever since Sam, has always had an everyday low price focus. So the company's focused on value. But that being said, as they balance all these stakeholders, they will have to raise some prices. They'll have the lowest prices, though.
Mm-hmm. Yeah, it's interesting in a sense because it's never going to just be like, well, there it is, 30% on top of everything we brought in from China. Yeah, they obviously are constantly in this dynamic process of figuring out where they can maybe capture some price and where they can hold the line. Do you see the kind of rhetorical, political elements of this being a little bit of an overhang on Walmart or not?
Well, I'm excited with Walmart's bargaining power.
Yeah.
Also, this company does a very good job managing very much stakeholders across suppliers, companies, and the commitment to U.S. Doug McMillon is a great ambassador, and I think they're doing a great job managing. They'll also stay very value focused on certain items like bananas, like coffee, like roses. Well, they'll strategically keep those prices pretty low as they think about elasticity. So they'll manage carefully within categories. And they'll offer great value. Another retailer we like a lot is Costco.
Yeah.
And our top idea this year is BJ's, because those are retailers that focus on membership and offering you the very lowest price possible.
For BJ's, is that obviously just kind of the model, the warehouse club model, or is there something happening there at the company in particular?
Yeah, there are a few things happening. They're really thinking about pricing analytics and being sharp there, also managing within categories. But that being said, it's a very attractive warehouse club model. As you think about Sam's Club, Costco, and BJ's, they're well positioned to win in this tight environment. BJ's also has 260 stores. Sam's and Costco have over 600. So and they're positioned to win because the prices are only at 11% spread, very, very small, and it's more about keeping members.
You mentioned this tight environment. So what's your assessment of the current consumer backdrop, the tone of the consumer?
Yeah, it's a consumer that's on pause, really, a consumer that's featuring needs over wants, and a consumer that's really struggling and still impacted by inflation. Certainly, consumer confidence is very volatile. That being said, there's a bit of a dichotomy because we have low unemployment at 4.2% and $800 billion of savings on the sidelines. So the consumer has money to spend, but it's been very volatile, something we're watching. I'd say middle, low-end customer under a lot of pressure.
And where would that give you caution in terms of the types of companies in that world?
Yeah, unfortunately, it's been much tougher in the shopping mall and apparel and discretionary. And as you know, Mike, the tariffs will have impact on appliances, anything you plug in and home. So we're watching that. Target, hopefully it's better than feared, but we're on the sidelines at a whole. There's still negative comping. Of course, you want to get positive growth. And then we're more cautious on department stores as well. Quiet luxury is working. Our luxury idea is Richemont Cartier, but we're being very selective there as well. I think the name of the game is being selective and thinking about this choiceful consumer and winners and losers. Just thematically, you want to own retailers that really focus on value and low prices, such as Walmart, such as Costco, such as Elf Beauty, too.
Okay. Cartier's quiet luxury?
It is. It's quiet but loud. But thinking about quiet luxury, they've done a good job actually maintaining prices. Some of the handbag prices have gotten insane, like 2,000 to 3,000, and you can get a Cartier ring around 2,000. It's also a little more discreet. It's gold, it's versatile, and it's timeless, and there's resale value.
Right.
So there's aspects of this that are less branded. I would say it's quiet, loud, but quiet.
Gotcha. Excellent, Oliver. Thanks very much. Appreciate the thoughts today. All right, up next, we'll hear from the COO of Toyota North America. We'll get his take on tariffs, manufacturing in the U.S., and more in an exclusive CNBC sit-down. Closing bell. We'll be right back.
You said Jeffrey Epstein committed suicide. People don't believe it.
Well, I mean, listen, they have a right to their opinion, but as someone who has worked as a public defender, as a prosecutor, who's been in that prison system, who's been in the Metropolitan Detention Center, who's been in segregated housing, you know a suicide when you see one, and that's what that was.
He killed himself. You want me to get, I've seen the whole file. He killed himself.
You said
Welcome back. Automakers caught in the crosshairs of the trade war, and that is putting big pressure on a company like Toyota. Phil LeBeau is live at the company's U.S. headquarters with more. Hello, Phil.
Thank you, Mike. Mark Templin, the Chief Operating Officer for Toyota North America. Big week for you here at Toyota.
Oh, absolutely.
Introducing the new RAV4, your best-selling vehicle, almost 500,000 you sold last year. But you also build it in Canada and Japan, and a lot of those are the ones you sell here in the U.S. How are tariffs impacting what you're doing with the RAV4?
Well, let me break that down in two pieces. You ask about the RAV4. We are excited about launching that this week. We're going to launch actually 7 vehicles this week with many journalists, analysts, and investors that are going to be here. And we're going to show them 7 vehicles, including the new RAV4. And we're excited about the RAV4 because of the things you just described. And that is, it's the best-selling compact SUV in the marketplace, has been for 8 years. In fact, last year, the RAV4 was the number one selling vehicle in the entire marketplace of any kind of car. And it's at the end of its life cycle. So we're excited to create a new one. But let me tell you what the designers and the engineers had to do. They had to say, okay, what's the benchmark in the industry? Well, it's not someone else's product. It's the current RAV4. So they're trying to make the current RAV4 even better.
But you build over 60% of the ones you sell here in the U.S. in Canada. You have more that come from Japan.
Yep.
How are you handling the impact of tariffs?
Yeah. Well, very carefully. Right now, we're kind of in a wait-and-see arena. But I will tell you, in terms of the RAV4, I want everyone to know that we have invested in the United States for 68 years now. For nearly 7 decades, we've been investing in America. We've invested $50 billion here to sell cars. We have 14 plants across North America. 11 of those are right here in the U.S. More of the RAV4s will be built in Kentucky with this next generation, but we will continue to build it in Kentucky, Ontario, Canada, with some coming from Japan to meet demand in the marketplace.
But pricing is still an issue, especially with inventories at the level. Look, you have 10 days inventory out there.
Yeah.
You clearly are getting hit with tariffs. How are you passing along those costs? Or are you just eating it?
No, we're absolutely in a different place than the rest of the industry. For the last 60 days, the industry's had a lot of cars on the ground, and so they've been able to sell cars that aren't getting those tariffs. In our case, because our dealers are selling through our inventory as fast as we can build it. This year, we'll build 200,000 more cars than we did last year, and the dealers are still going to sell right through it. They end every month with 10-day supply of cars, and they're asking for more. So we're not worried about that piece of it. We are a little bit concerned about what the future holds, because the administration, they understand how complicated our industry is, how capital intensive it is, how long the product development cycles are, how long the product life cycles have to be to amortize the cost for that. They get those things. They also understand how complicated the supply chain is and how fragile the supply chain is for our parts makers.
But the industry prices, be honest with me,
Yes.
They will start going up at some point. Is
absolutely.
it in June? When do we see industry prices, not just for Toyota, but everybody, start to go up?
You're absolutely correct. 25% tariffs are unsustainable. Nobody has profit margins like that, so everyone will have to eventually. My guess is as soon as the other automakers run through their inventory and they get down to the level we are, there's going to be some people that start taking those. And then once a few automakers do that, everyone else will have to follow.
So when do we see prices go up?
Well, you've already seen some of them go up. You've already seen.
But widespread, would you say June?
Absolutely. I think when you get to June or the end of June at least, you're going to see people they're going to feel the pressure and they're going to have to do it.
Mark Templin, COO of Toyota North America. I told you it would be a quick interview.
Good to see you.
Good to see you.
Thanks.
Guys, we'll send it back to you.
All right, Phil and Mark, thank you so much. Up next, we are tracking the biggest movers as we head into the close. Christina, what are you watching?
Well, we are looking at a streaming giant facing a Wall Street reality check, plus a vaccine maker stock soaring on a conditional FDA approval. Those names after this short break.
17 minutes until the closing bell. The S&P 500 hovering just below the flat line. Let's get back to Christina Parkinellis for a look at the key stocks to watch. Christina.
Let's look at Novavax shares, jumping more than 14% after the company secured a long-awaited U.S. regulatory approval for its COVID-19 vaccine, but not without any conditions. It can be administered to anyone aged 65 or older, as well as to individuals aged 12 to 64 with at least one underlying condition. That contrasts with Moderna's Spikevax and BioNTech's vaccine available to everyone over 12, regardless of risk factors. But Novavax, as I said, up 14%. Netflix stock dropping right now after JP Morgan this morning, an analyst downgraded it to neutral while also raising his price target to $1,220. Despite maintaining his long-term bullish outlook on Netflix streaming dominance, the analyst cited the company's elevated valuation following its 30% rise this year and nearly 400% surge just since October 2022. Separately, for all the parents out there, Netflix just picked up Sesame Street worldwide streaming rights along with PBS after HBO didn't renew its contract. So it's been saved. Mike?
Just another reason, I guess, to hang on to the Netflix subscription. Katrina, thank you. Still to come, solar stocks sinking in today's session. We'll tell you what's weighing on those names. Closing bell. We'll be right back.
everywhere.
Up next, Fairly is Katie Stockton standing by to break down the final moments of the trading day. The Market Zone is next. We are now in the closing bell market zone. Solar stocks getting slammed. Pippa Stevens has the details. Plus, Diana Olick on the housing fallout of rising rates. And Fair Lead Strategies' Katie Stockton on the critical levels she's watching heading into the close. Pippa, let's start with these solar names. I think it was just last week where they were flying.
Yeah, that's right, Mike. So solar stocks are slumping today as the new draft of the reconciliation bill could lead to an earlier phase down for some of the key clean energy tax credits, although no time frame for that possible step down has been released. The credits have helped spur record clean energy deployment in the U.S., but have drawn ire from some Republicans, including President Trump, who has called the Inflation Reduction Act the Green New Scam. First Solar is the biggest loser in the TAN Solar Fund today, falling more than 9%. Sunrun, SolarEdge, and Array Technologies also in the red. But today's weakness does come after the group surged last week after the text of the initial tax bill was not as bad as people within the clean energy industry feared, with JP Morgan saying it was at the more bullish end of investor expectations. But with all this uncertainty around the crucial credits, the group is likely going to trade on sentiment and remain volatile. Still, Goldman upping its target on First Solar today to $255. That's 56% above where it currently trades. Mike?
Yeah, volatile and sentiment-driven. Pretty familiar for the solar stocks. Pippa, thank you. Diana, kind of the bond market acting as a gatekeeper for housing yet again.
Absolutely, Mike. Yeah, the average rate on the 30-year fixed went back over 7% this morning, 7.04 to be exact, according to Mortgage News Daily. That is the highest rate since April 11th. It did fall back slightly along with bond yields this afternoon to 6.99%, but still higher than it was on Friday. Rates began rising sharply at the start of April after President Trump announced wide-ranging tariffs. They then began coming down a bit, but really they haven't moved much at all this month, despite the announcement of a 90-day cut in Chinese tariffs last week. We did see a pullback from buyers, though, in April. Pending sales of existing homes, that signed contract, down 3.2% compared to April of last year, according to Realtor.com. We did see a bit of a comeback in mortgage demand in the first 2 weeks of May, but that was when rates were sitting right around 6.9%. And believe it or not, there is a difference, Mike, between 6.9 and 7% in people's heads.
That's right. More than 1/10 of 1 percentage point, it would seem, Diana. Thank you very much. Katie, great to have you here. We have the market. Look, it's acting pretty resilient. Again, we had an opening drop, and then we've clawed back to the flat line. But overall, this rebound rally we've seen from those lows in early April, it's definitely impressive. Is it convincing in your mind in terms of, does it mean that we are resuming an uptrend?
I would say the short answer is no. Because usually when we see these violent relief rallies, they're more often found in bear market cycles. So that's the bad news. But the good news is we are almost back to where we started, almost a round trip. So we had this nice 23% gain over the last few weeks for the S&P 500. And it's given us what I feel like is a bit of a gift. For stocks that have broken down, people now have an opportunity to reduce exposure into that strength.
So you would be more inclined to look for something to sell up here because you think the overall market is vulnerable to backsliding? We are generally in that kind of sell into strength mode, and we're still comfortable holding core long exposure. We like that long exposure right now to lean more defensive, both on the sector front and even outside of equities on the asset class front. But the high-flying tech stocks, in fact, most of the stocks that exhibited upside leadership off of that April low, we would imagine will probably exhibit downside leadership, just that high beta nature. And that's going to include most of the mega caps, including Microsoft as one example. A great move from Microsoft. It's right up near its highs again. But it does have, as of today, a counter trend signal, the first of its kind since the rally began. So with that gap that we saw in Microsoft a couple weeks ago, it does start to feel overextended. There is this sense out there, and it's the way the market seems to act, that it just feels as if there's just a lot of money that feels left behind by the rally, and maybe there's just this catch-up instinct out there. I know a lot of the analyses of institutional positioning shows them having been very, very underweighted stocks. Maybe that's back toward neutral now. But I wonder what the evidence is telling you about whether we've seen a culmination type move, right, in this rally, because sometimes there are things to look at that say, okay, we've kind of squeezed all we can out of this rally.
We like to look to the VIX to that end. The VIX is a great transactional gauge of market sentiment, and I would argue that the VIX, being inversely correlated to the S&P 500, is now on support and quite oversold, showing some signs of stabilization. In fact, this morning we had a little bit of a gap up that I'm sure you noticed. That gap up does hint at a shift in volatility, a shift in market sentiment that is more likely to yield a pullback in the S&P.
And can you handicap in terms of whether, are we going back to the former lows if we do lose this bid, or is it just kind of we have to chop around?
I would say that we have a good chance of going back to the lows. I can't assign a probability, but when you refer to the monthly charts, the monthly indicators, things like the MACD, which is very popular as a trend following gauge, these are pretty new sell signals. So they have implications for the most part through year end. And it would be hard to imagine that the bear market cycle that we think is underway is going to have already culminated with that April low. So we're mentally preparing for a lower low. If we see signs of downside exhaustion arise above that level, that'd be great. Our initial support for the S&P 500 is just shy of 5,500. That would be, like, to me, best case scenario. Would love to see that. I think more likely is a return to an important Fibonacci zone of support, which is closer to 51.25.
Yeah, I know that is a pretty widely watched area. You mentioned some of the higher octane, higher beta stocks that did lead off the low. The inverse of that, I guess, is some things that look like they really got overdone to the downside. UNH is bouncing today. I know you've taken a look at that. What does it look like to you?
That's right. And listen, healthcare even more broadly has really taken a beating, especially in relative terms. And all of the pharma names, a lot of the big biotech names like Amgen, Regeneron, they look really oversold. And it goes both in absolute and relative terms. We highlighted a counter trend signal today in UNH. It's not for the faint of heart to buy it necessarily into this weakness, into this big downdraft, but for a relief rally in relative terms and for the most part in absolute terms in the healthcare arena, I think it seems very likely. And it would be natural if you think about it as associated with the pullback in the S&P 500, where you do tend to get that more defensive sector positioning.
And is healthcare where you would look if you felt as if you wanted to shift back toward defense at this point?
Right now, I'd say from a short-term perspective, it's definitely high on the list. I wouldn't say I would limit exposure to that. A lot of these names still look pretty terrible from a technical perspective on their long-term charts. They have not established basing phases. But if you look at Johnson & Johnson, even Merck and Pfizer look pretty oversold, and they do show some indications that they should release themselves from their doldrums.
Just a quick word on the bond market. 10-year Treasury yield, do you have a target?
Well, we do think it can reach about 474. That's a resistance level. It's a strong resistance level, but looking for more choppiness, really more of a neutral bias.
Great. Katie, appreciate the time today. We covered a lot here. As we head into the close, we do have another relatively firm close. The S&P 500 crossing just over into the green at 59.64. We did open up about 1% lower. The Dow is going to finish up by 1/3 of 1%. Even the NASDAQ composite is managing to finish above the flat line. That does it for Closing Bell. We'll finish overtime with John Ford.
Well, that bell marks the end of regulation. North Point Bank shares ringing the closing bell for the New York Stock Exchange. Enact doing the honors at the NASDAQ, and markets ending the day higher with the Dow the best performer, third up day in a row. S&P eking out a little bit of a gain, roughly flat, notching its sixth straight day of gains technically. Treasuries in focus with the 30-year yield crossing 5%, touching that level. That's the highest level since 2023, though it did close below that. And healthcare was the sector leader today, with United Healthcare leading those gains, adding to Friday's gains, posting its best two-day rally for that stock since 2020. While home builders and home-related stocks, though, moving lower today as the 30-year fixed mortgage rate crosses 7% again, and a number of names hitting all-time highs today, including Visa, TJX, IBM, MasterCard, and Booking Holdings. Well, that's a scorecard on Wall Street. Welcome to Closing Bell Overtime, where winners stay late. I'm John Fort. Morgan Brennan is on assignment. Markets shaking off that Moody's debt downgrade, but few would deny debt and deficits are a problem. That as we got a battle in Washington trying to get a budget bill passed. We will talk to former Council of Economic Advisors Chair Jason Furman about what's next there. And stocks have rallied strongly off the early lows. Is it a continuation of the bull market or just a bear market rally? Dan Niles is going to join me with his take. Well, now a mixed session on Wall Street with the Dow finishing the day in the green, the S&P and the NASDAQ flat. Yields spiked following that Moody's debt downgrade on Friday, putting some pressure on stocks today. So could a sell-off in treasuries lead to a sell-off in stocks? Joining me now is Carson Group Chief Market Strategist Ryan Dietrich and Richard Bernstein's Advisor CEO, Richard Bernstein. Guys, happy Monday. Back at it. Richard, yields and the tax cutting that Congress is doing, this was supposed to stimulate the market, but this Moody's ratings cut, if nothing else, raises the specter of fiscal issues pushing the other way. So what should investors do here, and why do you think European quality is part of the answer?
So John, great to be with you. I think, look, the thing that hasn't gotten, I think, enough attention has been yet another downgrade of the U.S. Treasury, right? That we are no longer investment grade. This started more than a decade ago. It's continuing. There's nothing good to say about that. And I think even though day to day, the 10-year may trade in one direction or another, the reality is for like the past 14 years, the Treasury is sold at a premium yield, in other words, a risk premium relative to AAA rated sovereign debt. So we're already being penalized as a nation. It's clear that what's going on right now is not going to help that, whether it's a downgrade, whether what's going on in Washington or anything like that. On the stock side, I think you're absolutely right. The quality, I think one of the things that we have to come to grips with here, tariffs, no tariffs, downgrade, no downgrade, the profit cycle in the United States is peaking. That would happen regardless of what's going on in Washington. And I think that's the most important investment issue right now, because it really argues that people should be looking at quality. They should be looking at defensiveness. They should be looking at cash flows. And if you want quality, the cheapest quality in the world is in Europe right now, and it's doing very well, and still nobody cares. So I think there's a tremendous opportunity there.
Okay, we'll talk more about that. But Ryan, first, you were bullish through those dark market days in April. You say the trade woes are behind us now, but there are still significant tariffs on either way, and some fear there's going to be a reckoning with stretched consumers. Why shouldn't they worry?
Yeah, John, thanks for having me back. Happy Monday, everyone. I would think I was on with you exactly a month ago, on April 22nd. So about 20 trading days ago. The S&P has been down only 3 of them. And when you think about what's going on, I mean, listen, all these worries and concerns are real. We're not ignoring everything that's out there, but are we listening to what the market's doing, right? The previous 27 trading days, the S&P is up close to 20%. Okay, what does that mean? That's not a bear market rally. That's not a short covering rally. Times we saw that much strength, John, in 1 month, off the 74 lows, off the 82 lows, off the 2009 lows, off the 2020 lows, and right now. Okay. I mean, I get it, right? All these worries, but all this over the top negativity. Yes, earnings probably are not as strong as they were going to be at the start of the year. We get it, right? But all the people thinking that how bad everything's going to be, we're going to avoid all this negativity. And that is why, those markets come back like it has. And I will say, we like Europe also. We like Europe. We like developed international. We've got some European exposure and the money we run for our Carson partners, but we clearly are still overweight equities and have a good deal of U.S. large caps in there as well. We still think U.S. going to play catch up with the rest of the globe here the rest of this year, John.
Okay, so Richard, investors still love risk in this market, even if Moody's doesn't. You spotlight the biggest tech stocks here, ex-NVIDIA, as being unworthy of their multiples. Tell me more.
Yeah, so John, I think, we can argue all day long whether the Magnificent Seven are magnificent companies, but the reality is they're not unique. And by that, I mean, if you look at the median forecasted growth rate for the Magnificent Six, take out NVIDIA, because NVIDIA skews the data a little bit. You look at the forecasted earnings for the Magnificent Six, they're supposed to be up about 8% over the next 12 months. Their earnings are supposed to be up about 8% over the next 12 months. The median company in the remaining 493 of the S&P is supposed to be up 9%. Their earnings are supposed to be up 9%. So the Magnificent Six of the 7 are actually inferior growers relative to the remaining of the market. So the question has to be what's so special about these companies? And I would argue the answer is nothing. They're clearly not going to grow faster. They're much more expensive. They don't offer dividend yields. There's a clear differentiation starting to appear here. And I think that's very important. The other thing I would just say, and just to push back on what Ryan said a second ago, you look at 82, you look at 90, you look at all these other periods, 2009, you would not find individual investors carrying a beta in their portfolios of 1.7, which is where we have right now. We have credit spreads incredibly narrow, not wide. We have individual investors taking risks like they've never taken before. That's a little bit different from, I would say, from the periods that Ryan is talking about.
Ryan, what do you say?
No, what's so unique, and Richard's got a good point here, because off this rally, who's really been buying it, right? Mom and pop, retail investors, hedge funds are still short. Most institutions have missed it. That Barron's big money poll, where'd all the bulls go? That was just 2 weeks ago. So this is a really unique situation. But one more thing that has caught us, of why we're optimistic here, market breadth leads price, right? We went over 5 months without a new all-time high on the NYSE advanced decline line. Just hit a new high last week. Once again, when you go a while without a new high, only happened 6 times. 1 year later, up double digits every single time on the S&P 500. So can we have some near-term volatility? Sure. But 6 to 12 months from now, we think we're going to avoid a recession, and this is still a lot of upside for investors, and that's something to be grateful for, given where we were 6 weeks ago.
Richard, I think the argument for a better multiple for the Mag 6 would be AI, the idea that you got hyperscalers in there, you got Apple, and if this AI story is true, and if this transition is similar to the one that we saw from the web to mobile, the the big names actually didn't get crushed. They benefited more than many people expected. You think that's not worth betting on?
Two things to push back on there, John. Number one is if the profit cycle is indeed peaking, capital spending is a big part of the profit cycle. It's fueled by the profit cycle. If profits are starting to slow, profits growth is starting to slow, corporate CapEx starts to slow. What's corporate CapEx supposed to be all about? AI. So it may be that people are a little too optimistic on the forecast for that. Second thing I want to point out is there's kind of this notion that AI is vastly different from any other technological innovation we have ever seen in history. And I'm not sure that's true. I think certainly technology always changes the economy, but the key word is always changes the economy. And if you look at the 20-year period since the advent of the internet and everything that was supposed to happen there, U.S. productivity actually marginally got worse. So I don't know what everybody's doing on the internet, but it's not enhancing productivity demonstrably the way people argued it was going to.
Well, I know some of what they're doing on the internet. Richard, Ryan, thank you both. Well, Microsoft and NVIDIA, speaking of, are big tech's first movers in this current era of AI. Both are making moves this week that investors can dissect to better understand their strategies to stay ahead. The bottom line, they're both adding tools to knit their offerings into the essential fabric of AI's expansion. Microsoft today kicking off Build in Seattle, its annual conference focused on hardcore developers. The biggest news for investors, I think, in Microsoft is embracing Model Context Protocol. It's a way for third-party AI agents to take the wheel and steer Windows or other apps. And meanwhile, over the weekend at Computex, NVIDIA CEO Jensen Huang unveiled NVLink Fusion, a way for other chip makers to hitch their custom CPU chips to NVIDIA's AI specialist GPUs. Qualcomm, Marvell, Synopsys among the early partners there. If it works, the tools might serve as a strategic moat, similar to what the App Store did for Apple's iPhone. It was just easier to build and sell games on iOS through the App Store, so developers offered their best products there, which fueled iPhone demand. We'll have to see if it works for Microsoft and NVIDIA in AI. Well, House Republicans approving the president's big tax and spending bill, but the path forward is rocky, with fiscal hawks saying the bill doesn't go far enough. What chance does the bill have if it makes it to the House floor? We will ask Jason Furman, former CEA chair, plus the race to replace Jamie Dimon, a big focus at JP Morgan's Investor Day. The market has loved Jamie at the helm, with the stock up more than 6x during his tenure. We're going to have the latest from today's meeting when Overtime comes right back. Welcome back to Overtime. The market's mostly shaking off the Moody's downgrade of the United States credit rating, but the $36 trillion and growing national debt is concerning to many, especially on Capitol Hill, as a new budget bill is getting negotiated. Emily Wilkins has the latest. Emily.
Hey, John. Well, yeah, the Moody's downgrade, it's really given fiscal hawks leverage to push for even more spending cuts in this mega bill. And look, the mega bill, it cleared a hurdle. It was approved by the Budget Committee last night, but 4 Republicans voted present. And that's a warning sign that while discussions are progressing, they have yet to get to yes. One of the 4, Congressman Ralph Norman, told me on Friday that the downgrade puts extra pressure on speeding up cuts, like cuts to clean energy tax credits and implementing work requirements for Medicaid.
Well, we've been downgraded 3 times. We have problems with the money in this country, the debt.
And it's not just the 4 on the Budget Committee either who have opposition to the bill. Congressman Scott Perry also tweeted that Republicans need to work harder this week to get the job done right, especially since America's credit rating was just downgraded again due to historic fiscal mismanagement, and we're careening to $1 trillion more in debt. The Trump mega bill is likely to add about $3.3 trillion to the debt. That's according to an estimate from the Committee for a Responsible Budget. But of course, that's just the House bill. We expect the Senate bill to change. But the White House this week really starting that push for the House to get their bill done this week. We've learned that Trump will be on the Hill tomorrow morning meeting with Republicans, and we will certainly be covering that meeting. John?
Emily, is there any sense of what it would take to get the necessary Republicans to yes, and then the degree to which that would endanger the bill in the Senate?
John, it's really a tricky balance, because if you want some of these cuts that the fiscal hawks have been talking about, say, take these energy tax credits, if you make sure that they phase out as quickly as they possibly can, there's another group of about a dozen Republicans who say, hey, these tax credits are benefiting our districts. They're creating jobs. We want to have them. That could jeopardize them on the bill. Or if you go further on Medicaid cuts, that leads to another group of Republicans who say, hey, we need to make sure that that some of these programs remain in place. They benefit our constituents. So it's really a delicate balancing act here. We know that Speaker Mike Johnson is having many meetings throughout this week. He expects the bill to be on the floor on Thursday, and he has said that he expects negotiations on this bill to be going right up to the time that they have that critical floor vote.
All right. Emily Wilkins, thank you. Well, let's talk more about that debt deficit and fiscal road ahead. Joining me now is Jason Furman, former chair of the White House's Council of Economic Advisors, currently a professor at Harvard's Kennedy School. Jason, good to have you back. So it seems like there's, even beyond the details here, this ongoing disagreement between the left and the right, Democrats and Republicans, over whether this is more about cutting government down and keeping taxes down, or if it's about bigger government and more, the upper middle and upper classes paying more. Isn't that the real issue here, that this administration and this Congress is trying to shift the balance?
Look, there are 2 separate issues. One is what is going to happen to the deficit and debt. And here, every single plan put forward by the Republicans this year would increase the deficit, would increase the debt. And in fact, the Senate plan would increase it even more than the House plan, which is currently under debate. Then there is, as you said, a separate issue of to what degree do you want to address things on the tax side or the spending side. Here's something notable. The House bill does cut spending. The Senate budget template actually increased spending on things like security and border, even more than it cut spending in areas like Medicaid. So the Republicans are much clearer about cutting taxes than they are about cutting spending.
What about the argument that extending the tax cuts is going to allow for growth that eventually pays for this? Why doesn't that work?
The original tax cuts that passed in 2017 had 2 parts. One, cut the corporate rate from 35 to 21%. I think that was pro-growth. It was important. That was also permanent. Everything that's coming up now was the more family-friendly, but less pro-growth part of the tax cuts. They've then added to it things like tax-free tips, overtime, and Social Security, that has nothing to do with economic growth. There's no tax reformer I know that was calling for those. Those were really campaign promises. So I do not expect very much growth to come from these tax cuts.
There's the issue of Medicaid cuts in here. And for a long time, that's been a third rail in American politics to talk about cutting Medicaid. Is it healthy to at least be talking about it? And are these cuts not reform?
Look, I think if it was putting everything on the table, I'd be for that. I'd put Medicare, Medicaid, Social Security, I'd put it all on the table. The issue here is the Medicaid cuts in this bill are designed to offset about 1/6 of the cost of the tax cuts, assuming they were made permanent. And so the Medicaid isn't about deficit reduction. It's just about paying for just a piece of the tax cuts. And I understand why a Democrat would come along and say, why do you need to take 10 million people's health insurance away to help pay for tax cuts? Let's put everything on the table.
What about Doge? I mean, we spent quite a bit of time over the past few weeks and months talking about that. And one of the issues that I continued to raise was, hey, aren't entitlements really the big issue here? How much are these cuts that are cutting scientists, cutting, sure, bureaucrats, but very knowledgeable bureaucrats in some case? How much of a difference is that really going to make to the numbers? It sounds like it's not making that much of a difference here.
Yeah, look, the Doge cuts aren't very much. Some of them will actually hurt growth through innovation. Some of them will hurt tax collections by scaling back the IRS. So it may end up costing us money, not helping us. And yes, you're absolutely right. I would love to see the type of bipartisan budget deal that's been talked about in the past, where everyone comes to the table, everyone sacrifices, everyone says, I need to give up a little bit. So for Republicans, they'd need to accept taxes going up. For Democrats, they would need to accept Social Security, Medicare, Medicaid reductions. That is the template that we should have. That's not what we're doing right now.
But cooperation is a bad word right now. I mean, we can't even talk about bipartisanship. It seems like in either party right now, the idea is, hey, while we've got any kind of advantage, we've got to jam our agenda through because the other side is evil.
Yeah, no, that's exactly the attitude. And I get that. That's been the attitude for a long time. But, the issue is life is long. And 2 years from now, there's probably going to be divided government. And now is the time to start building up some of the muscles so you can work together. They're going to have to do annual spending bills. They're going to have to do annual debt limit bills or regular debt limit bills. Even better would be if they could aspire to do something more. Social Security Trust Fund, that's exhausted in a decade. No one's talking about that. It is going to run out of money 10 years from now. The time to act on something like that is right now.
You say that there's going to be most likely a divided government, and I guess just historical precedent would suggest that. But I haven't heard much of a coherent economic agenda from the Democrats. Have you?
Look, midterm elections are generally referendums on the incumbent. So the Democratic message I expect to mostly be, here's the ways in which the world was made worse in the last 2 years. And if we do end up with these tariffs sticking, families really are going to be paying bills. They're going to notice it. I don't know that buying $2 instead of 30 for the family that wanted to buy 30 is going to seem like quite as easy an adjustment as the president made it sound.
Yeah, I don't know any families buying $30, but we'll see.
We bought that many stuffed animals over the last year, and I'm not proud of it.
All right, Jason Furman, thank you. You can afford it. Ahead, Mike Santoli breaks down why institutional investors may be racing to catch a moving train in the midst of this aggressive market comeback. And speaking of the turnaround, is this nothing more than a bear market rally, or is it the start of another long-term bull run? We're going to discuss when Overtime's back in 2. Welcome back to Overtime. First Solar closing down 7.5%, biggest loser in the S&P 500 today. That after reports Republican lawmakers reached an agreement to end clean energy tax credits earlier than expected as part of the deal to pass President Trump's tax and spending package. Other names like Sunrun, SolarEdge, and Enphase falling as well. Meanwhile, in the shade, the recent rally from the lows has been one of the fastest in history, and many institutional investors were forced to aggressively add exposure. Can that continue? Mike Santoli, what do you say?
Well, it can, John. We'll see if it will. This is a look at the composite investor positioning calculus by Deutsche Bank. So they maintain this indicator. It boils institutional and retail, different types of institutions into a single positioning indicator, equity exposure. And you see it had one of its biggest ever jumps in history in a single week to that level, which is just below neutral. So you see how negatively positioned people were near the lows. Of course, very steep on the downside and the upside. It's really kind of looked like a V bottom in risk appetites. Now, at these extremes, it serves as a contrary indicator. So this is like the very early part of 2018. That was a kind of a major short-term peak. Obviously, you see the low in the sell-off in COVID in 2020. There is room for institutions to buy back more. But which types is an interesting question. The types that are most underweight are these kind of mechanical, systematic trading firms that basically just follow a set of indicators, whether it's the volatility level, whether it's a trend following kind of mode or something like that. People who've made a decision whether to be long or short stocks are more long, and they're kind of in. So it's all conditional, but we haven't yet gotten to that point where you say, okay, everyone's tank is full, nobody's left to buy, John.
Well, these exposure lines, is this showing U.S. equities or global?
It's U.S. At this point, I believe. It's essentially, it's a kind of a guesstimate of exactly how people are positioned. But yeah, it is pretty much focused on the U.S.
So what about this idea, and it's not just about flee the U.S., but we've had a couple people already talking about the attractiveness of quality in Europe. Might people buy in, but just not where they were before?
There's a chance of that. It certainly you saw a kind of gesture in that direction early part of the year. I still think, though, that you would see this migrate higher if people were topping up their equity exposure in general, because it mostly feels as if that, those things move more in tandem than they don't. And a lot of this is people closing out short positions, at least in the initial phase of this. So, there's nothing that says it has to go to the top end of the range here anytime soon. And mostly that's going to depend on how the market itself behaves. But I do think it's gotten outsized importance simply because it was so dramatically skewed to the negative. And the strength of the rally, as you guys were just talking about, retail investors never really wavered. The strength of the rally did leave a lot of the professionals flat-footed.
Yeah, a lot of them got their ankles broken in April, as we say, in the NBA Finals. Mike, thanks. We'll see you in just a bit. Well, time for a CNBC News update with Kate Rooney. Kate.
Hey there, John. President Trump signed a bill this afternoon that bans the distribution of non-consensual sexually explicit images and videos, including those created by artificial intelligence. That bill, called Take It Down Act, includes harsher punishments for those who post images or threaten to do so, and it also forces online platforms to take the images down within 48 hours of being notified. The New Jersey man, though, charged with starting the massive Jones Road fire last month, the wildfire, says he should not be held responsible because he tried to put out that fire before he left. After a brief court appearance today, Joseph Kling told NBC Philadelphia that there were others there with him that should have snuffed it out. Prosecutors say Kling set wooden pallets on fire and left without extinguishing the flames, which ended up burning more than 15,000 acres. And the USTA is making its largest investment ever in the U.S. Open. The tennis organization said today it's investing $800 million to modernize and upgrade Arthur Ashe Stadium in Flushing, New York, without the help of taxpayer dollars. That project is expected to be done just in time for the 2027 U.S. Open. John, back to you.
All right, Kate, thank you. Now ahead, another big week of retail earnings on deck with Target, Home Depot, and some high-end names like Ralph Lauren set to report. Were Walmart's earnings a harbinger of things to come? Will we hear more companies warn of price hikes? The retail read is ahead. Welcome back to Overtime. Let's get a quick recap on the markets. The Dow with a more than 100-point gain. The broader averages overall were higher. S&P 500, NASDAQ, both closed the day up, but only by a few points on those, but good enough to continue a winning streak for the S&P, now at 6 straight sessions. United Health, the big reason the Dow ended higher. That stock rebounding once again following last week's big sell-off. It's now up 14% in the past 2 days. That amounts to a small portion of what it lost. Gold, also a winner today, steered by softer dollar and safe haven demand on that Moody's U.S. credit downgrade. Treasuries also on the move on that downgrade. The 10 and 30-year yields both higher, just short of 4.5 or 5% on each of those. Well, JP Morgan down about 1% today as it holds its investor day. It's a chance for Jamie Dimon, CEO, to share his views on the economy and perhaps a chance for the rest of us to see who might replace him someday. Let's bring in Leslie Picker for a look at what we've learned. Anything, Leslie?
It was a chance, John. I don't know if we got that chance, but Diamond certainly fielded questions related to everything from Bitcoin to regulation to private credit and, yes, to succession. He did say nothing has changed on succession, noting his timeline is up to the board. He shared some updated thoughts, though, on the fiscal picture and the, quote, huge deficits that he sees, and spoke about the trade war as well.
My own view is where people feel pretty good because you haven't seen an effect of tariffs. The market came down 10%, it's back up 10%. I think that's an extraordinary amount of complacency. That's my own view. That when I've seen all these things adding up that are on the fringes of extreme kind of thing, I don't think we could predict the outcome, and I think the chance of inflation going up and stagflation is a little bit higher than other people think.
He said even if they stay where they're at today, the tariffs are still, quote, pretty extreme. And he notes we still don't know how many countries are going to respond. Diamond said he thinks the geopolitical risk is, quote, very, very, very high. He thinks the odds of a recession with inflation, stagflation, in other words, are about 2 times the level that the market thinks. And he says credit losses in a recession will be worse than other people think. He said he's not a buyer of credit or wouldn't be a buyer of credit today, that it is a bad risk, John.
Leslie, on succession, it's starting to remind me of the Bob Iger situation over at Disney, where it's almost they're insulted that you would bring up the idea that one day they might not be CEO. Is there a situation at JP Morgan yet where they're losing top talent who would be good CEO candidates because they think it's not coming anytime soon?
Not in recent years. It's funny because the question that was posed to Jamie Dimon in this back and forth was essentially the analyst or investor had asked ChatGPT, who is kind of the pop culture icon that Jamie Dimon reminded them of, and the AI the chatbot kind of responded that it was Iron Man. And then the investor said, well, Iron Man never retired. Why do you need to? But it does seem like that's certainly something that's on the board's mind. It's on Jamie Dimon's mind. And it's pretty clear that the heads of the business are the ones that they're at least looking at this point in time as potentially taking that job. The question is more around timeline, which there was a B of A note out actually this morning, which said that, if there were indications that he planned to stay 2 or 3 years, that would actually be bullish for the stock. So it seems like it's one of those situations where there is this collective agreement among the analyst community and the investor community that they want Dimon to stay. And it really kind of comes down to the board and their timeline.
Okay. Well, Iron Man did retire after the blip, but we won't be Marvel nerds about it.
I never saw the movie, and apparently Dimon didn't either. He's like, I've never seen that movie. So,
all right. Leslie, thanks. Well, the S&P 500 rallying more than 17% since the early April lows. So, is the bull market back on, or will this turn into a bear market rally? Dan Niles joins us on the other side of this break with his take. Stay with us. Welcome back to Overtime. Treasury yields are spiking today following a downgrade from Moody's on U.S. credit rating, sending the 30-year yield above 5%. That's a level not seen since November of 2023. My next guest believes that the rise in yields carries higher inflationary risks rather than signaling an economic slowdown. Joining me now is Niles Investment Management founder and portfolio manager, Dan Niles. Okay, Dan, I know that you've been skeptical of this market's overall direction, though allowing for some of the spikes we've seen. Well, what's your take? Fill that out on what's happening with yields right now and how it affects stocks.
Sure. I mean, I was expecting a rally. You had me on an interview on April 7th, and I said, look, I think we might see a short-term bounce because you get these bear market rallies in the midst of these sell-offs. And, you know, if you go back and you look at the global financial crisis as a good example, you had two rallies in the S&P of 18 to 19% on your way to new lows. You want to go back further to the tech bubble, you had three rallies actually between 19 and 21% in the S&P 500 on your way to new lows.
So you think we're getting new lows?
I wouldn't rule that out in the fourth quarter. And here's the reason why, John. So you brought up yields earlier, obviously. That's something you got to pay attention to when the 30-year is bumping up against 5% and the 10-year is bumping up against 4.5%. And the question you asked is, well, if you look at those yields, why are they doing that? Well, yes, tariffs, thankfully, on China have gone down from 145% or so to 30. I think they ultimately will go closer to 10. But at the end of the day, tariffs overall are going from about 3% to start the year globally to probably low double digits. That's inflation in the pipeline. So I don't think the Fed's going to cut at all this year. The more important thing is if you look at the U.S. economy, we're about 1/4 of the world's GDP. We had a 41% increase in imports in Q1. So when you pull forth that much demand because people are scared of tariffs, Apple airlifting 600 tons of iPhones, and you have consumers going out and buying PCs and cars and whatever else, you're going to have a payback during the holiday period. And to put it in perspective, during COVID, you had an 88% increase in the third quarter. But that's because you had imports go down 12% in the first quarter and 54% in the second quarter. So you were just doing catch-up.
To clarify, you're saying we probably ended up pulling everything into the U.S., not everything, but almost everything we need for the entire year in these first two quarters in the first half because people are trying to get ahead of tariffs?
Yeah, absolutely. I mean, you heard it on the Walmart conference call where they're like, you know, we can't adjust to this and we're going to have to start raising prices. And you've seen this interesting thing where imports surged in Q1, then they collapsed in the month of April. Then when the tariffs got rolled back, they've started to surge again. And so all you're doing is you're just pulling forward an unbelievable amount of demand. I mean, think about it. 1/4 of the world is the United States, and imports were up 41% in Q1. You don't think that pulled forward some demand?
So then what's the impact on things like jobs, whether we're talking ports or warehouses, et cetera, when the demand for new goods from overseas dries up, regardless of what domestic consumer demand is doing if the supply is already here?
Well, and that's the problem, because you go into the holidays. What's amazed me is how many companies on their conference calls for Q1, because remember, Q1 earnings came in better than most expected. I expected them to be good. If you go back and read what I said going into this earnings season, because I thought the pull forward in demand would make companies sound optimistic. I thought there'd be a rally through early May. We've obviously gotten that. But the thing is now, people just, you look at the estimates for the full year, and the third and fourth quarters haven't been cut. So either you believe tariffs have no impact, inflation coming through the pipeline has no impact, yields up here have no impact, and you're going to get double-digit earnings growth for the full year, or you're going to walk into a situation much like, if you remember, in 2021, the S&P went up 27%, even though inflation surged from 1.4 to 7%, because everybody wanted to believe it was transitory. Then you got into 2022, and the S&P got clobbered for 19%. And I think that's kind of the situation you're in. I think because of underpositioning, you're going to see guys chase. It wouldn't surprise me if you get to new highs on the S&P, because people want to believe that everything is great. And then you got a huge issue in the fourth quarter when holiday sales don't come in.
So that's
with what
absolutely the picture you see, what you think is happening. So give me the scenario, low percentage though you think it is, where you're wrong here. Is it there's some stimulus in domestic demand that actually chews through that inventory and therefore that buildup isn't a big deal? Is it that there hasn't been as much pull in as you expect there has been? How are you wrong?
You look at 41% import growth, John, on 25% of the world's GDP. How are you going to spur that much demand? So I think the question is, how bad is the holiday quarter going to be? Because this is just, to me, like thinking inflation was transitory in 2021, which I was on your network plenty of times saying there's no way this is transitory. I think this is one of those situations where underpositioning, Mike Santoli did a great segment on that earlier, is going to have guys having performance anxiety. People want to believe it's good. I don't know how you get out of this very easily, because it's not like the Fed's going to be able to cut with tariffs in the pipeline. Obviously, they're trying to put through tax cuts or make them permanent, et cetera. But in general, the government's trying to cut back spending because of the deficits, and, which look like they're going to go up.
Okay.
And so it's hard for me to figure out how you get out of this when the S&P PE is at 23 times. In the short term, enjoy it. It could go up some more, but then I would get very cautious as you head into the holiday quarter, especially given companies are saying, oh, yeah, we didn't have much pull-in on their Q1 earnings calls, which makes no sense.
All right. Well, we're going to watch the numbers, of course, as we always do. Dan Niles, thank you.
Thanks, John.
Coming up, comparing the two biggest companies in the world by market cap. Microsoft has the lead over Apple in market cap. Has been a clear outperformer this year. Will that trend last? Mike Santoli's got more. The battle of these two mega caps. You can guess the other one. It's NVIDIA when overtime returns.